Welcome to episode 9, Selling Call Options on Tesla, breaking it down by IV, Implied Volatility. I'm going to show you how option call sellers did on Tesla, just before its big rise in the pandemic through July of 2022. Teaser, I found something, a trend clear and undeniable. I'm planning a multi-part series on Tesla, this being the first. This one is about backtesting Tesla, breaking it down by different ranges of implied volatility. Last episode on Moderna, I showed you how the market mispriced its options too low. The IV was too low, the options were too cheap, and option buyers did well. This motivated me to add a new feature to my backtester, filtering and grouping by IV. I suspected Tesla's options were also priced too low during this period, but we'll see. Maybe something interesting emerges. We'll visualize some individual backtests and then look at an aggregate backtest chart which tells an unmistakable story. We'll consider what strategies could have been used during this period. Feel free to give your opinion in the comments. This is not trading advice. Do not do this because I say it worked in the past on Tesla, or even because of this thing I keep hinting at. This was a special time. Pandemic, money printing, and Musk fanboy mania. Just because it worked here does not mean it will work in the future. First time here, this channel is about running backtests on options, usually selling options, and talking about the results to see if they might apply to future situations. If this sounds interesting, please like and subscribe. Feel free to request a backtester feature, and let's get started. The Yahoo chart in the background is Tesla from August of 2019 through July of 2022. Same as the backtest that we'll show shortly. Lots of volatility, and the market probably didn't anticipate this much. So implied volatility, there's a lot of good YouTubes about what it is. I'd suggest you go search and watch some if you don't have a good understanding. I will not waste your time giving a boring, detailed explanation of it, other than to say it's the market's guess on how much an option could move in either direction. It's computed from the current prices of options. When the market guess for IV is too high, which I believe is the more common scenario, then option sellers will make money. When the market guess for IV is too low, like in Moderna in my last episode, or GameStop during the start of the meme stock frenzy, then option buyers will make money, potentially a lot of money. Just looking at this Tesla chart, I'm pretty darn sure the market will not have anticipated this much volatility and priced options too low. Here's a chart from one of the backtests. Its IV range was 0.68 to 0.99, 1,154 call option legs, all these blue lines here. The minimum volume was 500. Tesla options have a lot of volume. Deltas and DTE were allowed to vary widely. Delta was 0.1 to 0.5, and DTEs was 2 days to 60 days. The yellow lines at the top represent Tesla's stock price. You'll notice the big drop in price from here to here. This is because of the 5-to-1 split on August 31st, 2020. The data doesn't have enough info to normalize for splits. So I've removed all option legs that cross over this split date here. Notice that there were several legs in the IV range just before the split, these right here, and they lost a lot of money. There's a few gaps in the chart just because there weren't any option legs with this volatility during these time frames. Overall, this range of IV 0.68 to 0.699, lost about $12,000, which is right here, about 12,000, which works out to 120,000 times 100. This chart is just one example of the 22 backtests. Each test had its own unique range of implied volatility. This one was pretty typical of the middle common IVs. We're going to see the aggregation chart now that gives you a good look at how they compared. Here is the highly anticipated aggregation chart. Soak this in for a few seconds. This is from the perspective of an options seller. Each group of 3 colored bars, like these 3 or these 3 or these 3, shows the results of a backtest for an implied volatility range, like from 0.5 to 0.54, or from 5.75 to 0.6. Blue is the average profit loss of the backtest per leg. Yellow is the average length in days of a leg. And red is the number of legs in the backtest. So the red values are described over here on the right y-axis, and the yellow and blue bars are scaled on the left axis. Along the bottom, the x-axis, is the IV range for the bars. For example, I showed the 0.68 to 0.69 range earlier, and that would be this one here. You remember it lost about $1,200, and it had about 1,150 legs. Anyway, you might be asking why I chose these groups of IV ranges. It was trial and error. I ran these a few times. I tried to find values where each one would have about 1,000. Did the best that I could. So what do we see in this chart that is so earth-shattering? Maybe not earth-shattering, but there are 2 things that stick out. Profit lost did better without question as the IV increased. Even turned impressively positive toward the end, the highest IV. And the average length of a leg, the yellow bars, decreased as IV increased. So the profitable ones were very short legs compared to the other backtests. So please don't take this to mean you should go out and sell the highest implied volatility options with the shortest DTEs. That's not what I'm saying. I'm saying that it just worked out this way for Tesla over this time range, which was a very unique time range. Pandemic, money printing. So this is very interesting. And what should we make of this? And I can't wait to run this on Moderna and GameStop and other highly volatile stocks over that time period to see if they showed the same characteristics. But anyway, let's go back and look at one of these ones that made money, maybe this one or this one, and see if we can take a closer look and see if there's anything interesting about them. So here is the highest volatility backtest. Volatility was 1.5 or above. That's a very high IV. You don't see that very often. You'll notice it had 575 legs, which is slightly less than the other legs, or the other back tests, I mean. And most of the profits were made right here, which was right before the stock split. So these are calls. So this is kind of surprising in that Tesla stock was going way up right before the stock split, so you would have thought the calls would have been losing money. But the implied volatility must have been so high that the options were set, or the strike prices were never got eclipsed. And you just made lots and lots of premium. But these are all, they're not spread out, they're all very clustered, so you're not going to have a lot of opportunities. Assuming this is something worth looking into, it's not going to be a common thing. So let's take a look at the detailed logs during that spike up we saw on the chart in July, just so we can understand what's going on. So here is the first record in July. We could see Tesla was trading at 1544. You got $26 for the option. Let's see, the implied volatility was right here, 1.54. And Tesla, it was for 14 days, and Tesla actually fell during this time period from 1544 down to 1417. So you got the full amount. Wow, look at this one. You got $120 was the price of the option. The underlying was at $14.97. You set the strike at $1,600. That was a very brave move, but it worked out because the stock went down and they kept all 120. So yeah, it looks like during this time period in July, well, there was a longer one. Didn't expire till August. One was 25 days. They set the strike price at $2,500. And the underlying was $14.97. The implied volatility was 1.6. So yeah, you kind of feel pretty safe about that one. And they got $44 for it. So yeah, all these really high volatility ones just caught Tesla just right when it was going down from like 1,500, 1,600 down to 14, 17. And then these in September were after the stock split, so you see the price has totally changed. So it looks legit. This doesn't prove anything, but it shows that for Tesla over this time period, most sold calls were losers. However, there were pockets of IV that were winners, clustered in the higher IV ranges at 1.0 and above. In the future, I'll be doing option backtests with IV on other stocks to see if this is a pattern. I'd really like to see if this trend also happens with Moderna and GameStop. I'd also like to do a popular low volatility stock that was good for sellers. Got any ideas? I'm not a financial advisor. This isn't financial advice. It's just a peek at the data with some comments. Thanks for watching until the end. Like and subscribe, and let me know if you have any ideas or would like any back tests or features.